Welcome back to another episode of the Omnichannel Marketer. This is your host, Kate Stevens. Today, I have a very, very close friend of mine, Liz Gordon, joining us, and we're doing something a little bit differently than we typically do. I know we're typically interviewing brands on this podcast, but whenever I talk to brands, one of their biggest asks is if they could meet investors. And given one of my close friend is actually an investor in brands, I thought we'd bring her on to, tell us a little bit more about her perspective as an investor, what she's looking at, what her firm is looking at in brands. So Liz, would love to have you introduce yourself. Liz is an investor at L Catterton, and I'll let you, give a little bit more about your personal background, and then also for our benefit, what L Catterton is exactly.
Happy to. And first, Kate, thanks so much for having me. This is such a fun moment, just given that I was able to watch Bridge from the beginning. It's amazing to see where Bridge is. And so love that you're doing this. My quick background. So I started my career, like many people, in investment banking. I was risk averse, had no idea, still am, had no idea what I wanted to do with my career, and felt like it opened a lot of doors for me. From there, I was really lucky and I landed a role at L Catterton on our growth fund. So I was an associate on our team, and I'll get into what L Catterton is and what we do. I was an associate on our team for about 3 years. I then had the itch to go work on the brand side. And we can talk about kind of the differences between being an investor and being an operator. I learned it is absolutely not for me. I have so much respect for everyone who does it. But I went to go work for one of our portfolio companies called Sweaty Betty. They're an athletic apparel brand, and I was helping bring them from the UK to the US, working on that strategy. I then went to business school, which is where we met. And from there, went back to L Catterton and have been back for about 3 years now.
Okay, so tell us a little bit more about what L Catterton is, what you invest in, and then I think more specifically what the growth fund does.
Happy to. So we are, just taking a big step back, the world's largest consumer investor globally. We have, I want to say close to 35 billion under management now across multiple fund strategies that span both stage and geography. Where we invest in the growth fund is, I like to think of it like the core of what L Catterton has been doing for 30 plus years, which is investing in fast growing consumer companies. And we are, generally speaking, the earliest point of entry for brands coming to L Catterton. We like to think of, on average, we can invest as little as 10 million up to 100, 125 million. And that is kind of where the demarcation between us and our flagship fund in North America. We have different strategies that focus, whether it's impact or geography, so our Latin America fund or Asian fund or European fund. But on the growth fund specifically, we are investing in all things consumer. So anything that touches the end consumer doesn't have to be purely a brand, but it's a lot of what we do and the earliest point of entry for those brands coming to L Catterton.
So it's the earliest entry point to L Catterton, but is it, typically the first time a brand is raising outside capital? And what is that entry point? What are, some of the basic metrics, top line that you would even take a meeting for?
Yeah, it's a great question. It's funny because when I talk to my friends in VC and I say the smallest that we invest is 10 million, people laugh because I still know that that is a large sum of money. That being said, sometimes we are the first institutional capital coming in, and I would kind of denote between brands that have been on a VC path and where we might come in there, and brands that maybe haven't been on a VC path but have gotten to a certain scale. As I think about what we look for when we invest, and this might vary by category, but there are three overarching themes. The first would be strong category. So we are thematic across investors across the board at L Catterton. What are categories and tailwinds that we like and that we believe are recession resilient and that consumers are spending their time and their money in? So that's one, do we like the category? The second for any brand would be, do we have proof points that they are winning in some area? That might be a specific geography. So you're winning in North America, you're winning in, one geography, or it might be you're winning in a channel. So you could be winning, and I know we'll get into Omnichannel later. You could be winning in D2C, not in retail yet, but that would be a proof point for us. And the third would be brands typically need to have working unit economics. And the reason we think about that is we are growth investors. So we're not investing at the earliest stage when there's a proof of concept or product market fit. We're really investing to put fuel on the fire and say, like, how do we grow this brand? And so brands don't need to be profitable from an EBITDA perspective, but we need to know that the unit economics can work and they're scalable.
And so, when we looked at businesses before, because I think we look at them very differently, you commented on margins and been like, oh, that's a good margin for this industry, or that's not. Like, what are the key, like, kind of back of the envelope margins and numbers that you're looking for to kind of get that gut on, whether something makes sense as an early look?
Yeah, and it really depends for the category. So I'll give a couple of examples for different categories. What I would say for anyone listening to this is like, don't hold these numbers, true and fast. Every business is different. And it will also, part of the reason margins are different by category depends on which channel you're in. So food and beverage, for example, are typically lower margin categories where we'll see like if you can get to 40%, kind of the average of where food and beverage should be.
When you're
Yeah,
saying 40, what is that margin? Like, what is 40?
sorry, 40, we think of that as 40% gross margin. And gross margin can be, the challenge when you start to double click on all these things is that everyone, even according to GAAP, which is standard financial accounting, there are variations in how public companies even will classify certain things. But typically, when you think about gross margin, you're thinking about your revenue less your cost of goods sold. And so for food and beverage, that's going to be around 40%. For categories like beauty, personal care, supplements, you're talking much higher. It could be as high as 60 to 80%. And so it depends as we think about gross margins across category and what we're looking at. It really depends what category you're in and what channel you're in.
And how does the current economic environment affect what you're interested in investing or not? I'll say from my own experience, I'm seeing the VC landscape, which is, definitely on the earlier stage, really pull back from consumer investing, consumer product investing. Do you feel similarly that you've seen a shift at all in kind of the growth side of the business?
Honestly, in terms of how we invest, less so. I think we're probably a bit unique in this way. We've always looked at consumer categories with a lens of what will be resilient during recessions and what are categories that consumers will continue to spend in despite recessionary environments. We might look at certain things differently if they're impacted by interest rates, but like that should be going in for us, for example, part of our diligence when we're looking at a company, whether it's a good recessionary, whether we're in good times or in a recessionary environment, like how does this company fare during recessionary times? We invested in Restoration Hardware as a firm right before the Great Recession, and it was a great investment for us. So I think like we tend to look at it more holistically and say, where do consumers want to spend their money and what are larger tailwinds, and think about that in the context of what could happen if there's a recession.
And, you kind of mentioned that you are a thematic investor. What are some of the themes that you're broadly excited about as a firm right now?
Always such a hard question. I would say, broadly speaking, and this has been a theme we've been following for a while, but overall health and wellness. And that can play across a lot of different categories. I think we're starting to see categories intertwine a bit more. So whereas something might have just been supplements before and something might have just fallen into beauty and personal care, we're seeing a lot of overlap. Other categories we like things that are like, if I'm talking within health and wellness, we like things that are science backed. It goes to show product quality, product efficacy, and there's points of differentiation there. We've had a long thoughts for a while on personalization and consumers wanting things that are custom for them and getting more demanding in terms of their everyday life. And so we're starting, we'll look at within health and wellness companies that play on all those categories.
Makes sense. And how much revenue, what is a typical top line revenue brand when they could come in the door at L Catterton?
I get this question a lot when I'm speaking to brands and other folks. The short answer is we don't have a threshold. And I know that's really hard for brands to hear sometimes. It really depends on what the company is doing. We've invested I'll give an example. We are investors in 2 alternative protein companies called Aleph and Wild Type that are pre-commercialization. but we believe in their technology and what they're trying to achieve and the challenges they're trying to solve, that was an okay stat for us, knowing that they were pre-revenue. Whereas other businesses, I think if I'm going to use like an extreme example, if you're a widget business, we would want to see traction. And so it really depends. The other factor that we look at, like a third dimension in some ways, is how long did it take you to get to that revenue and what's your scale bid? We might be okay investing, and I'm throwing numbers out there, in a food and beverage business that's doing 10, 15 million in revenue if they got there in a year. If it took them 10 years to get to that point, we might have a different lens in how we look at it.
And then on that kind of lens question, just because I don't know that everyone fully understands the difference, how would you explain what you're doing as growth investing, relative to venture investing?
It's a great question. I personally think about it on two dimensions. One is how our fund portfolio is constructed. And I don't want to make generalizations for each venture firm as well, because everyone does it differently. But typically, when I think about venture investing and you think about people early stage, a venture fund will say, I need every deal to be able to return my fund. And I'm investing so early that I need every deal. I'm going to make up numbers to have the potential to get to $1 billion outcome. And knowing that maybe 8 of the 10 deals I do in my fund, or rather 25 of the 30 deals I do, are going to be zeros, and those 5 that work out are going to return the fund. For us, we are much more structured in the sense of not every deal has to return the fund, but we're not looking for those deals that have a 20, of course we would love a 20, 30x time on our deal, but we're looking for a more concentrated band of returns. And therefore, we're more concentrated in how we invest, what our portfolio looks like, and how we can be hands-on with companies. That's like the fund structure. I think for us, and VC has now spanned so many different stages, like we absolutely come across VC firms when we're looking at companies. It goes back to my comment on unit economics and having working economics that we can put capital behind to efficiently scale a business.
So moving back to metrics, I know we talk a lot about, and brands talk a lot about LTV and CAC and the ratio between those two. Could you, help define what those two things are and help me understand the way that a brand should be thinking about those metrics?
Yeah, it's a great question. It has evolved over time, and I think similar to gross margin, like many people have different ways of looking at these metrics and comparing. For us, the most simple way that I could explain it is that the LTV is what do you get from the lifetime value to a customer that comes to your website over time. And so what that means and what it's going to tell us, if we're just looking at the LTV part of the equation, is how healthy are your customers? So if I'm trying to think of a good example, a beauty business, for example. Okay, I'm going to take Oddity. They just went public this week. Super excited about that one. If I acquire a customer and they come and they first buy a lipstick from me, on average, how many times do they come back? What are they buying? What is not just the lifetime revenue of that customer, but when we go back to margins, if you take a percentage, so let's say in beauty, for example, generic beauty, you're talking 70% gross margins. If you take 70% of their lifetime revenue over a period of time, that's how we would think about lifetime value. And then you have to say, okay, across a cohort of customers or a group of customers. So I might have my best customers that come back 10 times and my worst customers that never come back. What does my lifetime value look like on average across all my customers? So that's kind of, I know I threw a lot out there. If I were to distill it, to me, it's around repeat and retention.
And what are good repeat rates for, I guess it's different, or maybe using Oddity, like for a beauty brand?
Yeah, it's really hard to say. I think I won't put numbers on it, but what I will say is you want businesses that have a propensity to repeat. And so that repeat can be it can be something, if I look at Hydro or Tonal that we're in, or Peloton even, where you have a subscription component in the business. It can be something like a beauty business where people are replenishing their foundation or their mascara continuously. Those businesses are more attractive to us than businesses where it's a one-time purchase. And you're saying, I'll give an extreme example of a one-time business. I think a lot of mattress companies, right? You buy a mattress and then you don't need another mattress for another 10 years. Now,
Mm-hmm.
those D2C mattress companies have looked for opportunities to expand their LTV by going into adjacent categories. But if they just sold mattresses and did nothing else, that would probably be an example where you'd acquire a customer, they'd make a purchase, and they'd come back 10 years later, maybe.
And now what about the CAC side?
So the CAC side is a little bit harder, and we'll get like this goes into omni-channel marketing too, right? Because the simplest way to measure CAC is to say, what's my paid media spend on Facebook and Instagram and all the dollars that I'm spending to acquisition. And I guess even if I take a step back, for those who don't know, CAC would be customer acquisition cost. So what does it cost me to acquire a single customer on average? You're going to look at your spend over your new customers acquired. It gets complicated when you start to say, okay, I'm going to use an example. I have a billboard out there that I can't track my spend associated with that, the dollars that went into the billboard. Or I have a retail store and I know that people in this zip code, when we have the store, go online, but I can't actually track the dollar spent.
Mm.
And so it definitely gets more challenging as you think about omni-channel. But if you look at it on a pure digital basis, you can look at your paid media dollars and your new customers acquired and track how much it costs to acquire a customer.
Yeah, let's double click on the omni-channel side and then we'll go deep there. But stepping back, what does omni-channel mean to you, to L Catterton, and how do you think about that across your portfolio?
It's an interesting question. I think increasingly so, and I'm going to make a generalization, we're seeing more of a need for businesses to be cross channels. I think the heydays of just being direct to consumer are probably over, but there are always exceptions to the rules. I'll go back to Oddity, like they've built an incredible platform that's all digital, and they've proven that they can scale that platform that's just digital. For me, omni-channel in some ways is meeting the consumer where they are. So that might be even being on Amazon and D2C and knowing that your consumer is shopping on Amazon and saying, we're going to think thoughtfully about our Amazon strategy because we're going to meet the consumer where they are.
And so, as it comes to calculating a omni-channel LTV, how can a brand even begin to start?
I don't know that there's going to be one LTV number that you're going to get from omni-channel.
Why is it so hard?
I mean, it's a lot of what you're solving for too, right? At Bridge, which is you might be selling your product into Target or CVS or Whole Foods, and you don't know who the consumer is. You can't track every dollar spent there and what consumers are getting from that and who's coming back. The consumer's also being omni-channel, right? I might purchase for the first time in a store because I saw it there and replenish online, or vice versa. What I would say is I go back to what we said earlier around LTV, which is, to me, it's a sign of repeat retention, loyalty, and customer engagement. And so I would encourage brands to say not what is my holistic LTV, but rather how do I get proof points of those metrics across different channels. So LTV on digital is much easier to get. You can track on your own .com website how many times a customer comes back, how many times they repeat. If you're talking food and beverage, for example, you might purchase data through different providers that give you indications of how quickly your product is being purchased on shelf and compare that to other brands. So it really depends on the channel and the category, but it is trying to get a sense, to me, fundamentally, like how healthy is your consumer and how do you compare against other brands?
What have you seen brands doing, or what has impressed you in the way that brands are attempting to calculate or show these proof points?
I think what always impresses me is brands that have a pulse on this, right? So when like brands that are tracking and have a cross channel and have a sense of what is my consumer doing? Why are they repeating or not? How frequently? And have not just access to that data, but then leverage that data to help them make better decisions as brands. It's not just data for data purposes, but it's what do I do with it now? And like if I start to see signs that are encouraging or less encouraging, how do I react to that as a business?
Yeah, makes complete sense. You mentioned cohort analysis. Could you just explain a little bit more about what that means?
Yeah, it is complicated, but I would say it's one of the things that we consistently look at for digital brands. So we talked about LTV to CAC for a single customer. Generally speaking, that's not going to be super valuable if you're trying to look at each individual customer and you have tens of thousands of customers. So what we might do instead is to say, what does a cohort or a specific group of customers look like? And how do we track those customers over time? Typically, we would do this analysis based on monthly cohorts. So for example, if I want to say, what does my January 2022 cohort look like? I would look at all the customers that I acquired in January of 2022, and I would say, how much revenue did they spend? I'm going to do a revenue cohort analysis, for example. How much revenue did they spend in January 2022? I now say, let's say you have 100 customers that month. If I track those 100 customers month after month, so those customers that I acquired in January 2022, what did they spend as a cohort in February 2022? What did they spend in March? What did they spend in April? You get the idea. You can then start to benchmark that. So I can look at in my first month of all my cohorts, what does that trend look like? After 6 months of being on a platform, what does that look like? And start to derive some analysis from that.
And why is doing it on a monthly basis relevant? Is it due with seasonality?
I think it depends for every business. If you were, for us at least, like so many of the businesses we look at are relatively new, that it's helpful to do it on a monthly basis. A, you're going to get a sense of seasonality, but B, you're going to get a number of data points. If you have a business that's been around for 20 years, you might say, I'm going to do it on a quarterly basis or an annual basis. It really depends on the business, if there's seasonality and how much data you have. What you can do when you start looking at something on a monthly basis or quarterly or annual basis is track improvement and changes over time. So I can look and say, are my cohorts getting better over time? Are they getting worse? Are they consistent? And from that, you can then start to do some actually cool predictive analysis to say, like, how many customers would we need to acquire this year to meet our targets based on how our existing customers perform.
And what are good LTV to CAC benchmarks? I know that it kind of rule
Yeah,
of thumb there.
again, depends on the category. I probably won't throw out like good, but I'll give you a sense of what we would look for. If you're looking at an LTV to CAC and over 4 or 5 years, you're only getting to 1 or 1.5 times, you're basically, for us, that's basically saying, well, your customers don't really generate money for you. They're paying back on your acquisition costs, but you're not getting much more than that. Whereas if you're looking at something that's 3, 4, or 5 times LTV to CAC, all of a sudden, not only are they paying back your acquisition costs, but they're generating money for you, and you can start to build a healthy business that way. And so it depends, like what I think about is, one, what period of time are you looking at? Are you looking at this over an LTV to CAC over a year, over 5 years? And then think about what that actually means for your business.
How have you seen, just with CACs rising because of the iOS 14 update
Yep.
and, just cookies sunsetting, how are you seeing brand behavior change accordingly or
I think,
reacting? Like, how are
yeah, what we encourage a lot of our brands to do, and the brands that are doing well, I would say, are ones that are diversified. And so, and when I say diversified, I mean diversified in their channel spend. So if you had a brand that was spending on, and I know not every brand has the money or the scale to do this, but they were spending on podcasts and on TV and on social and Google and Amazon and a variety of different channels, they were probably less impacted from the iOS changes than ones that were spending purely on social.
mm-hmm.
So for us, we always say like how, and at some point you need to be able to scale your marketing spend. So I would say as you start to get bigger, think about how you can build the infrastructure, test into new channels, and diversify your spend.
And this was not on our agenda of things to talk about, but I'm also just
Go
curious
for it.
with TikTok just being a growing channel that, feels more top of funnel, but now there's shopping functionality. How are you seeing TikTok enter the brand space or, what have you learned about that as a platform?
Gosh, Personally, I have learned not enough about it. As a millennial, I feel like I probably should spend more time on it to familiarize myself with TikTok. I think we're seeing it be a strong acquisition channel. How it's actually used, I'm not sure long term. I don't have great insights, but I definitely think we're seeing that brands that are spending on TikTok and engaging with their audiences there are seeing returns.
Cool. Okay, something that you are, bold or passionate about.
Okay, this is going to be a lame answer. I'm going to make it work related, just given the topic. I think one of the things that we talk about a lot on our team, we see a lot of businesses that have great ideas or great offerings, but the actual business model itself doesn't work.
Mm-hmm.
And we'll reflect back as a team of like, gosh, if only they built this business to be priced in a way that they could make money and that the business model works. And so I would say like building a business that can be sustainable long term. I think we are past the days of building a business for that next round of funding. And I think you see it in the public markets too. The companies that are profitable and sustainable are getting rewarded.
Yeah. Why do you think that, historically that's been so hard?
We've talked about this, and even in the context of Bridge, right? Like, I think when you're starting as an early business, you just want customers. And you're going to say, I'm going to figure out how to get customers in the door and learn from them, and I'll change my pricing later. I think while we've seen an interesting time over the past couple of years where the consumer has not reacted to price increases as much as they otherwise would have, like brands have basically been able to increase price without seeing a massive impact on demand. I think it's really hard to do over the long term, as opposed to just saying, what should my product offering be priced at? And how do I price a business for like early on, knowing that maybe I'll have fewer customers from the beginning, but long term, it might serve me well.
All business models are not created equal.
True.
So, okay, moving into our lightning round. Favorite omnichannel brand?
I'm going to be biased because it's the only one that I've worked at, but Sweaty Betty.
Thing that you wish you could change about our industry?
I would say, and this goes back to my earlier point a little bit, not every business needs to be a VC business or a VC funded business.
Favorite podcast?
I'm much more of an audiobook listener, but the one I always go back to is The Daily.
Favorite newsletter?
I really like, just from personal interest, Fit Insider. I think they do a good job of summarizing the fitness industry and general health and wellness trends and giving interesting takes on what's happening.
It's called Fit, F-I-T?
F-I-I-T, Insider.
Okay. Favorite social media channel?
Instagram.
So millennial of you.
What can I say?
Favorite book?
Recently, Lessons in Chemistry. It was so good, and it just touched on so many different aspects of female empowerment and science and women working. It was awesome.
Yeah, I also just read that, and it is excellent. Any event that you're planning on going to this year that you're excited about?
This is a hard one. As Kate knows, I'm expecting twin boys in the next month, so I feel like I have not made any plans for the back half of the year. I'm hoping to make it to our friend's wedding in October.
Where can people connect with you?
LinkedIn, or I would say if you just want to follow general trends and what we're thinking about at L Catterton, go to our website at lcatterton, CATTERTON.com.
Okay. Well, Liz, thank you so much. It was, we chat almost every day, but it was nice recording it and taking some of your learnings and sharing it with our audience.
This was so fun. Thank you for encouraging me to do it. And I'll talk to you soon.
Bye.
Bye.
If you liked this podcast, follow me and the Bridge page on LinkedIn and Twitter for hot takes and tactical advice. If you really loved today's episode, we'd love a review on the podcasting platform of your choice, Apple Podcasts or Spotify. Thanks for listening.